What a boring 24 hours in Davos, Switzerland, hey? That was quite a day one. I've got a sneaky feeling the next 24 hours is going to be a little crazier. We'll tease out some of those themes in this panel, so don't worry about that. I want to start the panel with the crazy of not just the last 24 hours, but really the last sort of 12 months. And I think the disconnect we all feel, I'm sure you feel and the panelists feel as well, the perceived disconnect between the chaos and the fact the equity market is still within 2% of all-time highs stateside, the elevated headline risk and the fact that credit spreads have rarely been tighter, and the fact that we're all sitting here trying to work out, are we mispricing the crazy? Or as my friend Rick Reeder over at BlackRock has said, just pricing a system built to withstand it, a system able to withstand it because of the massive amount of spending we've seen from a handful of some of the biggest companies we've ever seen on the planet. So I will say this up front on behalf of us all, that none of us have any idea if we're mispricing the future to the downside or to the upside, but based on the comments of this forum in the last 24 hours, it certainly feels like the world has changed. And it's our job to try and figure out, as we enter this process, to begin to understand to what degree. And I hope the next 43 minutes or so will contribute to that effort. Now, typically we sit on a panel like this and we introduce the guests, but I don't think these guys need any introduction, so I'm going to kick it off with Gita Gopinath. Gita, you've written about this, and I want to tease out that subject with you, that it's easy to walk away from the last 12 months and conclude that nothing has changed, but you believe everything has changed. Just walk us through it.
Yes, John. I mean, everything has changed for the global economy, and this question, answering this question, is getting harder by the minute, because what the future is going to be is tremendously uncertain, and I think we're going to have an important speech later today that will tell us something more about what the future would look like. But indeed, everything has changed. Even if you look at the headline numbers and you see global growth is supposed to be 3.3% this year, which is exactly the same as last year, and in fact higher than what was projected before any of this policy chaos started. But we shouldn't take that as a sign that there is tremendous resilience in the world and none of the tariffs, or none of the policy chaos matters. I think what has offset a lot of that drag has come from AI, from both the investment going into AI, but also the stock market effect on wealth and therefore on consumption, and also because there has been more fiscal spending in many parts of the world, including in China, including in Germany, especially more so this year, and to some extent in the US, again, this year. So those factors are offsetting the drag that exists from tariffs. And we should also keep in mind is that there is a bit of a disconnect between headline numbers and what the statutory tariffs are, and the actual tariff rate, which is much lower. And that's one of the reasons why the effect has been weaker. But the reason I say everything has changed is more in terms of the breakdown in trust in the world between the US and Europe. Nobody is going back to the previous rules-based order. I think everything has transformed. None of it, I mean, some of it did require change, but the changes we're seeing are so dramatic that I think the negative effect is going to accumulate over time. So we're not going to see it today or tomorrow, but over the years, we're going to all find ourselves poorer.
Mark Carney of Canada said just yesterday at this forum that this wasn't a transition, it was a rupture. Emmanuel Macron, the French president, is accusing the Americans of trying to make the Europeans poorer. And then I look at the S&P 500. Robin, I just think there's nothing to worry about. S&P's good, all-time highs. Yes, a little bit of a sell-off yesterday. We've had record highs across Europe too. Is there anything to worry about?
Well, Jonathan, if you just step back for a second, I think what Gita said is also important, which is we've had a lot of fuel for the economy, and so we've had a lot of fuel for the stock market as well, the spending on AI, the spending on defense, the various different stimulus, government spending. So there is a lot of sort of coming off the back still of a long time of pretty easy money in a lot of countries around the world. So that's all fuel for economies. That's a good thing because we are seeing higher GDP. The US has outperformed most folks' expectations over the course of the past couple of years. Just think about where we were a year ago, 2 years ago. People were predicting a downturn, hasn't happened. And in fact, now looking forward to 2026, I think there's a certain optimism associated with how the US might perform. So that's number one. There is a reality to what's been fueling the economy, and therefore there's some industrial logic behind the pricing of the S&P. And remember also, you've got a forward question about what will be the impact of AI on corporate productivity, how will that feed through, what does that mean to PE multiples in the future when you think about potentially corporate earnings in a world of AI. So that's, I would say, part of the story. The other part of the story, which maybe isn't quite as optimistic, is the market is bad at pricing tail risks, especially ones that are quite far out of the money, and we've got a lot of those at the moment. So I could probably list off, as we all could, 20 different things, which probably each have a 5% probability of happening individually, and therefore they don't get priced in very well as individual things. But take 20 things at 5%, chances are better that one of them is actually going to happen. Markets just don't handle that very well traditionally. So I think this is the world that we're living in. We've got a lot of quite good fundamentals. We understand there are a lot of issues hovering around in the background, and the market struggles to be able to get that same balance that I think we feel, where on the one hand, on the other hand.
We've got some headline risks later on this afternoon in this forum. I believe 2:30 local time, is that right? I think it might be delayed, we'll see. The president addresses this forum. There's been plenty of questions, Sergio, about diversifying from US assets. I think Dan Iverson over at PIMCO talked about a multi-year period of diversification. We saw the Danish pension fund, albeit small, moving back from treasuries yesterday. We all read that announcement. Is that happening? Do you see that with your clients backing away from US assets at all?
Yeah, look, I think that maybe just to add on to what has been well explained in the previous interventions here, I just want to say that maybe, we are not very good, history tells us that we are always, able to rationalize excesses in the market, right? And this is one point that I would say is a takeaway that over time, we were going to see if, I fully agree that we will see the benefits of AI and the investment in infrastructure to play out positively over the long term for the economy. But we are not very good at predicting the next risk, and we are very good at rationalizing excesses historically. Now, to your question. Look, I mean, the big difference here is that diversifying away, the meaning of that. Is it true that you see pocket of investors underweighting their asset allocation to the dollar, to maybe some US assets? But it's almost impossible for the system or for a very big chunk of capital to take the risk to bet against the US and against the dollar. I think that, first of all, honestly, there is no choice to the dollar at this point in time in terms of, source of investments. And number two, things have to play out over the cycle. So while I do believe that what we see right now is somehow a discontinuity to what we saw in the last 20 years in terms of the world order, it's not going to be as extreme and as bad, no matter what today we're going to hear. So because who knows what's going to happen the day after.
Can I follow up with you on what we've seen in the last 24 hours? It's curious to me that all the headlines are about South America after a 6 basis point move at the long end of the curve, yet we had an almost 20 to 30 basis point move in Japan. And I didn't wake up this morning talking about a multi-year period of dumping Asian assets. So can you help me understand what's happening in the bond market?
Yeah, well, no, the issue is that I think that you now see clearly that the current situation in terms of deficit and is not priced correctly, and the market is trying to price that risk. But it doesn't mean yet that people are diversifying away. So when you look at diversification, you're now talking about the U.S. and before we spoke about or we heard about the U.S.-Europe relationships. Look at the U.S.-China relationship. That has translated into definitely a lower asset allocation of big investors to China. At the end of 2024, they had an underweighting of 2.5%. Last year, despite the big rally in Chinese stocks and the markets, we ended the year still at around 1.3% underweighting, right? So it means, but people are not moving away completely from assets. Right? So it's all relative, and I would say that diversification is, of course, now even more important. But we have to be realistic in closing that for the foreseeable future, there are no real alternatives to the dollar. And the U.S. market and the U.S. economy is still a very innovative economy, like the Chinese one, and you know, both of them are unavoidable places to invest in the future.
Bonnie, does your region offer an alternative?
Thank you, Sergio, for teeing it up for me so perfectly. I mean, the topic of this conversation, are the markets mispricing the future? I think the immediate reaction is to look at it from the vantage point of the U.S. market. But as you suggested, the world is so underweight China for many years. In fact, 2 years ago, you know, when I attend Davos, right, I'm still trying to argue with a lot of people whether China is investable or not. And it's very difficult when someone is set, you know, in his mind that, you know, a certain place is uninvestable. They always focus on looking for reasons not to invest. But I feel that we've come a long way. The conversation since last year has slowly pivoted to maybe we should pay attention again to see what Asia and China have to offer. And so now I feel that my conversation is more rich, more fulsome, in the sense that, you know, we talk about not just the negative aspects of things, but the pros and cons and the bright spots. And I do believe, looking at the performance of, I run the Hong Kong Stock Exchange, so the Hong Kong market, clearly there's a very strong return of interest. If I look at the IPOs, right, a year ago, if I tell anyone that, you know, Hong Kong is going to be the, you know, the #1 exchange for IPOs in the global league table, I bet not a lot of people will agree with me or will believe me. But as it turned out, we delivered 120 IPOs raising $37.5 billion. But interestingly, if I look at the, you know, who exactly are buying these IPOs, the diversification is in fact happening. So for a lot of the very interesting deals, especially in areas such as technology, you know, be it AI, semiconductor, new energy, the level of interest from international investors is very strong. And therefore, you know, if you ask me, you know, from my vantage point, is there mispricing? I think yes, but it's the opposite of what we are sort of concerned about with the U.S. market. I think people are still not really seeing the potential upside.
All roads seemingly lead to tech, though, Mark. It feels like it's all one trade, AI. And when we opened up this conversation and talked about what insulates us from the craziness at the moment, it seems to be the money that's been printed at some of the biggest companies on the planet. Is it more than just one trade in your world?
Yeah, so I think if you look at what all of this investment means, you have to look at what's, you know, the next step. And what's the productivity gain? So that's a key point, because if we think about where the S&P 500 is trading, think about where NVIDIA is trading, okay, or the other tech stars. If we're adding 1 or 2% of productivity gains to GDP over the next 5 or 10 years, or are we adding, on the high estimates, you can see people estimating 5 to 7%. If it's anywhere near 3, 4, 5, 6, 7% of productivity gain, no, this is cheap. These are cheap stocks, okay? And so where is it going? I think if we look at the market, we look at the tech spend that's happening, it's a matter of conviction. So I believe that the AI tailwind is not something that's going to stop tomorrow. Okay, this is a long-term tailwind that's going to happen. You know, we're not capable of choosing who the next NVIDIA is, but what we can do is invest in the infrastructure around it. One thing I'm certain of is energy creation, energy transmission, storage, water transmission, all of this stuff becomes more and more valuable, more and more important, and that's a multi-year tailwind. And you mentioned some of the politicians who are speaking about what's going on in their economies. You know, defense spend in Europe, defense spend in Canada, the budgets are doubling over the next 5 or 10 years. But that's not all going to planes and tanks and aircraft carriers. That's also going to AI spend. That's also going to quantum computing spend. So I think this is not a 2 or 3 year phenomenon that we're going to see. Now, if it turns out to be only 1% of productivity gains, yes, maybe it's overpriced, but there's this binary feeling in the market where either we're in a bubble or everything is green lights. There could be something in the middle. Maybe the productivity gains take longer to come online. So then maybe the valuations for certain sectors or certain companies are too high. But this is a 5 or 10 or 15-year phenomenon.
Can I take the other side of that? Because the way I hear it traditionally justified is that we benchmark it to the extreme. It's not the dot-com bubble, so therefore it's okay. And there's nothing to worry about here. So I would actually say that people look at history as a way to justify current pricing. It may never be the technology bubble. We may never see that again. And when I hear you talk about technology, you talk about the potential for the tech. But isn't that different to the way we price it in the market? The number one question I'm getting from people at the moment, and unfortunately they don't say it on Bloomberg TV, they say it offline, is what happens if OpenAI goes bust in 2026? What happens to the ecosystem? What happens to the way we price the whole market? That's a very different question to the potential of the technology 5, 10 years out, is it not?
Yeah, I also think you're right. I think drawing a parallel to what was happening in the dot-com days are totally different. These are assets that are making money, that are growing their earnings 30, 40, 50% year over year. If you take Anthropic was talking about their revenue going from 1 billion on run rate last year to 10 billion this year. These are massive gains, right? So I think there's an actual impact that we can measure. None of it can be completely parallel to the past because the future is always going to be different. That's for certain. But I also, one point I would echo with you is that if you listen to the economists or the big investment banks who are making their predictions for what the S&P 500 was going to be, or what the next rate cut cycle was going to be in the next 12 months, 3 or 4 years ago, yes, we expect 4 rate cuts over the next 12 months. None happened. We're going to expect 4 next rate cuts over the next 12 months. None happened. So yes, we're in a brand new world. Everything is changing daily. I do think volatility shocks like what we could hear today from President Trump could have a significant impact on the markets, and that could alter the course of where we're going. But I do think that still you have to try to look long term, which is very difficult in the news flow that happens on the...
Gita, just quickly, you wanted to jump in?
Yes, now I want us to make this distinction between the potential of the technology and where valuations are, both those listed on the stock market and those not listed on the stock market. We could very well have productivity growth of 1.5% a year, which was at the upper end of the estimates, and still we could absolutely argue that the market is overvalued. Because what we need to do is it's not just about productivity growth. We'd have to figure out, is there a way for all of these companies with very high valuations who are doing trillions of dollars in investment and making at this point tens of billions of dollars in revenue, that they would all be able to generate the profits that justify the scale of investment that's being made and the valuations that they have. That's what concerns me. I think productivity will go up. I don't have a doubt the productivity will go up. I just don't see how all of the current incumbents will be profitable, have the kind of profitability and have the revenue model that can justify their valuations. And the reason for that is that it is a competitive space at this time. I mean, I work with the different LLMs, and I keep switching between one and the other. One day it's GPT 5.2, then it's Cloud Code, and that's just within the US. You have DeepSeek in China. So I think things are changing in warp speed. It's unclear what the revenue model is going to be for companies. Yeah. And so I think that is what the question mark. So I actually see a disconnect. I don't necessarily see if productivity goes up. That means these valuations are justified. I think you could have you can have question marks over that. And so yes, so what is true this time around is that the companies, at least those listed on the stock market, unlike the dot-com time, are profitable companies. The revenue streams are not necessarily the big ones. The big revenue streams are not coming from their AI investments, but they're coming from other sources. But then you have the other companies that are not listed, like OpenAI, which have very high levels of valuation, and that could be the indirect risk that we don't see.
Bonnie?
Yeah, I totally agree with that. I've heard someone describe it. With AI, there are 3 FOMOs, right? There's the capacity FOMO, the application FOMO, and the investment FOMO, right? So the valuations we're seeing, right, is probably a product of this investment FOMO. on the expectation or anticipation that one day, right, everybody in the world, all companies are going to find ways to apply it, right? And therefore everyone is also chasing the application FOMO. But the productivity gain, which we talk about, has to be backed up by people willing to pay for that productivity gain, right? And I think, Mark, you put it as a time frame issue, right? I think the mismatch of timing, right, between how much people are willing to invest to chase the investment FOMO and when customers are eventually going to pay for that productivity gain and translate into the productivity of these companies. I think that is really what we need to focus on.
Robin?
I would actually split it into three different constituencies, because I think when we have this conversation about valuation, the way we should think about it is a little different. So we've got the folks who are producing what is increasingly day by day more of a commodity, which are the tokens. So the token manufacturers, that's where the real concern on valuation has really ended up being. And they are creating what is now a bit of a commodity. And so we'll see, is there space for 3 of them, 5 of them, 7 of them? We'll debate. They're spending a lot of money. They'll build infrastructure. The infrastructure is going to be used. The tokens will be created. It's manufacturing capacity. And if one of them were to fail, at the end of the day, we'd probably see some of the others taking over that manufacturing capacity. Personally, I don't worry about that too much. The second constituency is the ecosystem that's built around that manufacturing. These are the folks who are truly innovating with agents and with capabilities that are essentially using that manufacturing capability of the general intelligence from the LLMs. And that's a whole new ecosystem that's going to allow us to do new and fantastical things. And that's not going to go away. It's going to be highly relevant and highly useful to us as we build, as we see and use all of these different capabilities. And then the third group are the users. And that could be us as individuals, it could be us as corporations. And this is where also the parallel with the dot-com boom breaks a little bit. We didn't see the type of productivity gain that we're talking about here on stage for the users over a fairly short period of time back then that we could see now. We didn't sit here saying, wow, Amazon, my ability to shop online, the rise of AWS. We didn't see those things as transforming 1, 2, 3, 4, 5% productivity gains year after year compounding back then. Now that is how we're talking about it. So I think by looking at the three constituencies, you can say, is the market assessing where the value's ultimately going to be correctly, and how do we look into the future? There's so much obsession about that first bucket, that manufacturing of the tokens, but it's easy to miss the real adoption and integration, which is much more in the second two categories.
Sergio, where do you stand on that?
Well, look, I don't think I can really add much more than what has been already well explained by my colleagues here. But one thing I would say that you mentioned before, AI bust. I mean, AI is here to stay and it's not going to bust. Maybe some people may disappear. I mean, like in the old days, Netscape as a browser doesn't exist any longer. But but my point is that, of course, we touched on that. But when we talk about valuation, timing is very important. And this is the ABC of investing, right? So, I mean, the issue is that it's undebatable that even if it takes longer, we're going to create economic value. Mm-hmm. So, but what matters for investors is, number one, not pretending to bet on any of these players being the ultimate winner, because at the end of the day, it's going to always be a race. And the second one is that how long it's going to take to create this output, economic output. In every major transformation we saw in history, we saw the same elements of people in technology, for sure, overestimation of how impactful it will be in terms of financial returns, and underestimation of the scope of the changes. And going back to the infrastructure part of the equation, other people made that analogy with the railway system in the early days of the transformation of transportation, right? So it's exactly the same issue.
Is it fair to say that railroads don't depreciate in quite the same way GPUs do?
Well, maybe not, but it's an example on how a transformative process that created economic output, created some collateral damages. And we need to accept that some investors will suffer, particularly the ones who are trying to do stock picking in investing in the sector.
Mark?
Yeah, I think one point I wholeheartedly agree with you, Sergio, on is the importance of diversification. I think you mentioned that earlier. But there's diversification in a few different ways. I think diversification of asset allocation and geographic investment is important. We're seeing, I take your point before, never bet against the U.S. The U.S. is going to continue to grow, and it's going to be the big market to invest in for now and for the future. But what we're finding is a lot of our investors, for that incremental dollar that they have to invest, they find themselves underweight Europe. And so they're saying, okay, maybe now is a good time to rebalance because I'm very exposed to the US, I'm exposed to a lot of these tech names, so now is a good time to invest in Europe, and maybe I want to do it through the private markets, so we see a lot within our buyout business or within our infrastructure business. But the other way of thinking about diversification is within the asset strategy you've selected, and that's important too. And I think trying to find return streams that are kind of decorrelated, and that really limits your risk. In our infrastructure business, yes, we invest in data centers, but we also are the largest investor in Heathrow Airport. What drives the return for Heathrow Airport is very different from the data center that we're invested in. I think that's very important.
How expensive are those uncorrelated assets right now compared to the big theme at the moment?
If I was talking about this with an international investor earlier today, and for a very good performing data center today, yeah, they're expensive, right? And the multiples that are getting thrown around can be very high. Now, if we're talking about a trailing 12-month number or a forward-looking number, somebody said a good data center with lots of different assets that is well contracted should be 25 times. Well, okay, 25 times forward or 25 times trailing. But on the other side of that spectrum, I was talking to a big investor in the data center space today. One of their largest assets is fully contracted for 15 years with two counterparties, Google and the US government. That's pretty good paper. That's a pretty good long-term bet on who your payers are. So, yeah, they're expensive, but the upside potential is there.
You've brought up another dimension of investing in this world, in this market regime, and that's partnering with the US government. The state capitalism that we traditionally used to focus on with China is now coming out of the American economy. Gita, does that change the market backdrop?
Absolutely. I think each one of these events changes the backdrop. There is some bit of confidence that comes from all the regulation that happened to the banking system after the great financial crisis. You have all the stress tests, and I think part of the reason why every single event of this kind is not spilling over into markets is because there's a lot of faith in, or belief now, and justifiably, that there's a much more sounder banking system than existed at the time of the great financial crisis. The risk, of course, is that there are many other markets that were previously considered safe that are no longer safe, and that includes US Treasuries. If you look at the long end of the yield curve for the US, interest rates are above 4%, but you would ask yourself, well, that still seems cheap compared to the level of debt that's out there in the market in terms of the projected path of fiscal deficits for the US and the path of debt for the country. Well, even the administration recognizes that, which is why they're all shortening their maturity and selling at the short end of the yield curve to prevent the long end from going up. So we're setting ourselves up with a bigger conflict with monetary policy, which is in the off chance that inflation were to surprise on the upside and the Federal Reserve were to have to raise interest rates, it would be even more costlier on fiscal policy than it would have been a few years ago, because it's not just the US government, by the way, pretty much every government is moving to the short end of the yield curve. So we risk being in this world where we really don't have any truly safe assets. And one of the points I want to make when we talk about equities and compare it to the dot-com period, the scale of exposure is just much bigger. And it's not just US households and US equities, but international investors in US equities never been bigger. Just in terms of any scaled multiple of GDP or any measure, the exposure is big. So any correction, and it doesn't even have to be a very big correction, it doesn't have to be the size of the correction of dot-com, it could be half of that correction, I think the consequences of that for the world economy are larger this time around than back then.
Don't they have corrective options? I mean, one thing I would say, just to reflect on the European debt crisis, I remember people would always say Italy is poor. And coming from an Italian heritage, I would take offense and I would say, no, no, no. The Italian government is poor. Italians are rich. And I think the same point needs to be made about America. The government might be poor. Americans are rich. Don't they have options to do something about it?
That's usually not how things work. when you're in a crisis, the way policies get coordinated is the government steps in, does stimulus, the Federal Reserve cuts interest rates. If we're going to be in an environment where there are questions around central bank independence, then the Fed would typically in an environment like this do quantitative easing. And the question is, there going to be even more pressure on them to do buy large amounts of assets, of classes of assets that they shouldn't be buying. There's the risk of that. And on the fiscal front, again, debt is very high. So they are quite constrained on how much they can bail out economies. We've seen the last 5 years. I mean, I think the last 5 years has been, shock after shock in terms of the pandemic, war in Ukraine, Federal Reserve raising interest rates sharply, but there hasn't been a financial crisis. And I think the sense has always been that there will be the government, either the Treasury or the Federal Reserve and governments around the world to save the day. It's getting to be a harder and harder proposition over time.
And yes, Sergio, we sit here, given all those risks granted, and treasuries have a full handle, and inflation-based, market-based inflation expectations are still pretty anchored. Is that the right way to look at things, or is that complacent?
Well, there is a level of complacency in the marketplace, but this is nothing new. In the last few years, we had an enormous amount of economic, macroeconomic, and geopolitical events that in the past would have triggered on their own huge corrections, and not only temporary corrections like the one we saw recently, but more fundamental correction. But I guess the system is now used to an environment in which either governments or central banks will be the ultimate saver. So this is what is consensus in the marketplace, and is a very dangerous assumptions to make. I don't have any clear way to how to address that, and going back into the boring diversification headline, because unfortunately there are no safe assets. As you mentioned, there are no places where you can say, well, this is a place to go. Of course, I do see a pocket of undervaluations in certain markets, relatively undervaluations, right? So, for example, I mentioned before the Chinese market in terms of technology and innovation. I mean, if you look at multiples between the Chinese market and what China is doing every day in terms of innovation output, and the US multiples, then you have to say, this is not only is not reflecting the economic reality of two countries, basically having almost 50% of the GDP of the board, right? 40 plus, 45, but also the innovation power, which is quite exponential. So there are mitigating factors, but everything is somehow then influenced by geopolitical issues. Why it is that the Chinese stocks are under weight is because of geopolitical issues, and this is something that is going to take time to be addressed. And I don't think even in the next 24 hours we will get a solutions of that.
Bonnie?
Yes. Now, I do want to go back to one point that Gita has raised, and again, I agree with you that if things were to go wrong this time around, the impact will be much bigger. Because if you think back the dot-com days, the way that investors invest are very different with technology. And I'm surprised, right? Well, just 10 minutes away from finishing this session, we haven't talked about tokenization and all that, right? It's in every conversation since I arrived in Davos. That is just going to make the impact so much more difficult to contain, right? Because you can, in a way, say, well, we're making markets more accessible to everyone and being more inclusive, but at the same time, you're syndicating out the risk to a much broader population of people, all around the world, right? So I hope, we will be able to get to a safe landing, but at the same time, the craziness that you alluded to, John, I think this time around with, it will be multiplied, given the change of the way that investors are investing.
Bonnie's good at this. We have got about 10 minutes left, so think of some questions you might want to ask, because I'll open it up to you in just a moment. Sergio, final word.
Maybe I have more of a question around tokenization and so on and so forth, which is, in my point of view, is still out there. I fully believe that blockchain and tokenization is the future. Having said that, I still don't understand, because I'm not a scientist and I'm not such an expert, how quantum computing will eventually put a severe threat to that system, or, again, maybe not a fundamental structural one, but rather delay how long is going to delay the timing for implementation of this technology, because security, I mean, when you tokenize, then you better know that it's safe. Because, and this is the issue that I still don't reconcile, and this is something that, in my point of view, is not fully priced.
Just to conclude this panel before I open it up to the floor, can I make it very simple, and forgive me for being a journalist by only asking one question to just condense this whole panel down into, but the S&P 500, higher or lower by year end? Based on everything you've said, all these risks, is the S&P 500 higher or lower by year end?
For me, well, go on.
I don't mind going first. You have to prepare. I think this is the theme of the panel. You have to prepare for all of the eventualities, and you really have to be able to withstand the answer being lower. But actually, given everything going on in the world, I'd go with higher.
Gita?
I think I like the preparation part of it. That is important. Yes, I would go with higher, but probably not as high as what's currently being expected.
Mark?
Yeah, look at earnings. Earnings are good. I would say higher, but I think the line chart's going to look more like an EKG than a straight line up.
Yeah.
Bonnie, I don't know if this gets you in trouble or not if you have to answer this, so you can take a pass if you need to.
I will take a pass, but I'll focus more on my market.
Sure,
right?
please do.
All I can say is that it used to be the case that the Hang Seng will go hand in hand with the U.S. indices, but we're seeing now less of a correlation. We're hoping for the best.
Sergio?
Well, I mean, it's much easier question than the one I got last night on is the S&P going to be higher than last year? So that one, most likely we're going to be a little bit higher, but I think it's going to be, more importantly, still a very volatile year.
So ignore the speech
later. You're going to see
later.
spikes of volatility.
Hey,
and
ignore the speech later, we can all go home. Oh, right?
Well, we'll see. But, I told you before that, historically speaking, we are not very good at making prediction in Davos. So,
True. True. Questions, please. Please stand, the individual at the front here, please.
Yeah, thank you. Isabel Hartung, Different Advisory Boards and Tech. My question would be, you very much focus on productivity and how much it will be, and whether this is reflected in the pricing. From my point of view, the more disruptive potential comes from new business models, doing things differently, and in the end, then winning a competitive edge, which also means where there will be a total reshuffling of the landscape in the different industries to new ecosystems. And I'm just wondering, do you have a read of, how this will translate into any kind of pricing or market expectations? Because, this is still a big black box.
Yeah. Look, it's sort of a couple of themes that we've already talked about. One is it's very hard to pick winners and losers, and so it's hard to look over the horizon and be able to do exactly what you said in the last part of your question. But to the first part, I think lack of adoption and integration deeply of AI into an individual's life or a government or a corporation over the next 10 years is an existential threat. So doing AI fairly well is table stakes to being able to exist, because the cost difference and the efficiency and the capacity creation is so transformational that if you talk about compounding the sorts of numbers that we've talked about, 5-6%, whatever the number is, maybe it's 2, who knows, but it doesn't matter. Compounded over a 10-year period of time, it's massive. There are things in our company at BNY that we do today which cost 1% of what it is that they might have cost us to do a year or 2 years ago. You can't compete with a company that can produce things at 1% of the cost.
Yeah, and I would add that I fully echo that. And the reason why is pricing is going to go in favor of, mainly in favor of clients. And so the winners will use it to gain market share. I mean, of course, it's going to be accretive to shareholders. And this is the reason why it's essential, because it's not about you making less profit than your competitors. It's you being put under pressure by the pricing advantage of your competitor driving you out of the market. So I think it's very, very important. Of course, what we haven't touched on is the social transition. What does it mean? This transformation for jobs and society, and this is a broader issue than 4 minutes, but I can tell you that this is probably the biggest challenge we have in making the adoption, because big organizations are based on maybe you have some visions at the top, maybe not, and you have some levels of embracement of changes at the first level in the organization, but large organizations have some degree of permafrost. And in this changing environment is is the biggest challenge we have is really to find in 3 years' time that you are still competitive, both in pricing and capabilities.
We got any more? Any more questions? Why does everyone go shy at the World Economic Forum? Come on. What have we got? There we go. An individual at the front.
Hello, thank you for this really interesting panel. I was wondering, do you think climate change and the risk linked to that are well priced in today's market, or do you think that's going to change quite dramatically in the few years coming?
Anyone on the panel? Gita?
So this is obviously tricky, and it does depend upon the particular market, because some markets have become uninvestable. You basically cannot get housing insurance, flood insurance in some parts. That is being priced in. If you're a small island nation, your ability to insure yourself from catastrophes has become incredibly expensive. So we are seeing some insurance markets basically shut down, that they don't exist. And that is a challenge with housing, which we know that's a big problem pretty much in all parts of the world. And governments are trying to figure out how is it that they're going to fix this market? What is it that they can do to be able to provide insurance? So basically people have to relocate and they can't really live there anymore. Of course, there are other kinds of risks, which is about whether the assets that you have are going to become obsolete. The fossil fuels, how much is this going to be valued over time? That seems to be changing with the geopolitics, depending on how much support there is for it and how much there isn't. But yes, I do think climate-related events, already the implications that we see right now in terms of the kinds of financial instruments available for it, that's another big transformative area.
And I guess maybe, the two real issues that we need to face is that all these, developments are going to need a lot of energy. And how are they in conflict with the target of net zero, no matter if you look at the next 10, 20, or 30 years? So how do we get the two things converging? It's very, very important. And in that sense, I think that it's very important to really invest in new technologies for energy. And it's fair to say that today we are paying the price for demonizing nuclear in the last 40, 50 years. And it's very important that, it's unlikely to change in the short term, but it's very, very important we also embrace new way of production of energy, because it's no climate change and energy are the same kind of topic.
That wraps up our panel. We're on Swiss time, so we've got about 60 seconds left, so I'll round it up for us all. Can we have a round of applause for a wonderful panel today? Thank you for Mark, Gita, Robin, Bonnie, and Sergio. Thank you very much. Thank you.